Okay, in this video, I will talk about Chapter 7's homework. Okay. Let's just do kind of what we did the last time here. So again, I've printed these out and kind of wrote out what my thoughts were. And now I'm talking about it on the video, but I have to flip through the pages because it's in a different order each time, as I understand it. Okay, first one. What do basically financial statement forecasts do? So this is a definitional question. So again, my comments for these are a little bit more limited because there's these are the kinds of things that you can look up. But essentially, what a financial statement forecast does is everything that this course needs. It's how we do the valuation process and we analyze the credit risk within the company. Um, I mean, it um, can be used for the other things, but truly the best answer here would be that it is the essential ingredient of evaluation and credit analysis is what we use um, for those forecasts is within the valuation and credit risk analysis process. So hopefully I'm right. I am. See you later. Okay. This is also going to be somewhat definitional, but prior to the announcement of unexpected bad earnings, what will happen to the share price? So here, what do we tend to see? So if the bad earnings are not expected, typically before that, there's usually a cause of those bad earnings, right? Which would be a trend of the revenue falling or the cost rising. The unexpected bad earnings don't come out of complete surprise. Generally, there are analysts out there who are kind of what we would say is doing channel checks and seeing what's happening in terms of revenue and costs and would know well before the earnings announcement. And so, because of that, what we tend to see is that the share price, those individuals will sell, right? That think that the revenue is falling or that the costs are rising, so they will sell, which would mean that the share price would generally go downward. It wouldn't go upward. It wouldn't not change. Um, and it's certainly after you announce the bad earnings, it's not going to go up. The very, very, very rare case where it would go up afterwards is if you could say, nope, the revenue is fine, it's continuing to grow. The costs, maybe let's say, did go up, but they went up because of some really weird non recurring event, and it won't happen for future quarters. Not likely. You'll see a downward drift. Okay. Now again, I mean I've looked at these. So when I do say check my work, I mean there's a chance I could be wrong here when I'm explaining. I just want to put that out there. I don't know what the answer is until I'm selecting check my work. Which of the following statements is false regarding credit risk analysis? Um, this is something where as an economist it just bothers me to no end. Your option already, I'll talk about why this is the answer, but the Federal Reserve does not determine interest rates this way. It does not fix. There's only one interest rate that the Federal Reserve determines, and that is the discount rate. And that is not what most people think of when they think of the interest rate. Um, the Federal Reserve Bank does not fix interest rates, so that's how we know that that is false. Let's just make sure that the others are true, though, just so you can see that that is true. Um, High quality financial statements help a credit analyst see the true performance of their company. Yeah, that's true, right? Credit analysts look at those financial statements to see how things are going in as good of and true as a way as someone within the firm would be able to. Greater default risk is determined to exist when there's significant organizational reliance on a certain individual or customer. Yeah, because what if that certain individual or customer all of a sudden changes their business, right? Changes their supplier. Well, then you're going to lose a lot of revenue, which would put you at greater default risk. An estimate of a firm's future financial condition is very important to most lending decisions. Yep, because it's going to determine your solvency and liquidity, which is what lenders care about. So even by elimination, we would know that this is the right answer. Let's hope that it is. It is. Okay, let's look at the implied total earnings multiple. Okay. So what we need to do here is we need to look at the what we need to do is we need to look at the um, implied share price, and we're going to need to divide that by the reported earnings per share. So for that, we need to, we can see here, the simpler part here is we can see that the earnings per share for firm C is $18. And if we're looking at the implied earnings multiple, what we need to calculate is the implied share price. So, from this information here, right, we can see that. Oh, wait, I'm getting a call. 1 second. Oh, sorry about that. To get the implied total earnings multiple, we now need to divide the implied share price by the $18 earnings per share. To get the implied share price, what we would do here is take our $18 earnings per share and multiply it by the fraction of our permanent component. So that's going to be 13.5. And then take that same $18 earnings per share and multiply it by the 0.25 for the transitory component. Should be 4.5. So these do add up to 18. But then what we also need to do is we need to multiply these by the beta factors for each of these. So that 5 times 13.5 is 67.5. And then 1 times 4.5 is obviously 4.5. And that gives us an implied share price of 72. So now we're going to divide 72 by 18 to get our implied earnings multiple. And the answer is 4. Let's hope that is an option. It is. Now let's hope that we are correct. Oh, thank God. This one is a little bit more difficult, right? The application of the equation itself isn't complicated. It's just that um, we're doing a bit more of a valuation process here, which can get always a little bit more difficult. Okay. This is definitional. So FASB stresses what the primary objective of financial reporting is. It's that investors and creditors will have information where they can assess net cash flows, both their amount, timing, and uncertainty. So, what is the FASB's contention? Um, so, why does the FASB believe this? Is basically what the question is stating. Is it because they think that cash receipts and payments is the best indicator? I mean, it can be, but it doesn't have to be. So the last choice isn't really the option because of that uncertainty about whether it can or not. That current cash flows outperform current earnings in predicting future cash flows. In some situations, it can, but it doesn't have to be. So that's also why um, that option is incorrect. Users pay attention to firms' accounting earnings because this accrual measure of periodic firm performance improves their ability to forecast future cash flows. By definition, that is correct. Let's just make sure that option A isn't correct. Users pay attention to management's estimates of free cash flows because this information improves their ability to forecast future cash flows. Same like the last two options. It can in some cases, but it doesn't have to. Really, there is no certainty even in the valuation process, but having this true information about future cash flows does make the data a little bit more reliable, which is essentially what option B is indicating. Okay. Carrying amounts. So the carrying amounts for GAAP balance sheet, what's being used? Well, it's actually everything. Right, historical cost, that's part of the carrying amount. The discounted present value, that's part of the carrying amount. And the net realizable value, that's part of the carrying amount. So the only one we have left is the projected return on investment or the projected ROI. This one should be relatively simple because it is just definition of what the carrying amount is. Okay. Interest rate on a revolving loan. So for the interest rate on a revolving loan, what does it do? So a revolving loan, that'd be kind of like the equivalent of a paying back a credit card, paying back even something like a home equity line of credit. So let's go through the options. Is it below the prime interest rate? No. The whole point of a revolving loan is that typically um, it's unsecured, so you wouldn't see it be below the prime interest rate, which is basically the interest rate that the most credit worthy of companies receive. Would it be equal to the prime interest rate? Again, not likely because there's typically no collateral. Does it float? It does. If you look at your credit card statement as just an example, there is usually no stated interest rate. It's typically the prime amount plus a certain percentage, usually like 10 or 15% for a credit card. And is a revolving loan fixed? No, because a revolving loan allows you to take out the principal amount at any time and then pay it back after a certain period of time. You typically would not have an interest rate that's fixed because you're not actually borrowing the money right away. The revolving loan, the money is available when you need it. That is the revolve part of revolving loan. So it should float. It does. What does the interest rate? How high does it need to be? Um, um, except which? So does it need to? Does the interest rate need to cover the cost of administering, monitoring, and servicing loan? Yeah, the bank is a business and it has to cover its expenses. Does the interest rate cover a risk premium when loans are personally guaranteed by the borrower? It would have to, because the interest rate would be a little bit higher because a person's word that they'll pay back the loan isn't as valuable as there being actual um, collateral behind it. Um, the lender's cost of borrowing funds. Um, yeah, I mean, the bank has to supply the money in some way. And then finally, the premium for exposure to default risk. Um, yes, that would be part of it as well. So what am I missing here? Sorry, I got to read this again here. The interest rate charge must be sufficient to cover. Oh, duh. Sorry, I have to go back on what I said here. I misread this. This would have to be the risk. So the interest rate wouldn't be high enough, so it wouldn't be sufficient. It wouldn't be high enough to cover that risk premium because we're saying in this case, um, uh, it may be, you have to allow for the fact that it may be that some borrowers obviously are a bit more trustworthy than others or have a higher credit rating than others. So in this case, the risk premium in some cases could be higher, um, and for some, it could be possibly a little bit lower. So it wouldn't be sufficient to cover both of them. Um, so um, the interest rate itself wouldn't be just that risk premium. Like this is not the only thing that determines what the rate would be. I think this one's worded a little bit badly. I didn't word it, so it's not my fault, but it's not exactly clear. You wouldn't see something like this on the exam, and I hope to dear God I got this one right. I did, thank God. But you will not see something like this on the exam. I wouldn't let something like that slip through because it's just not worded very well. It's not worded well because I got it wrong, but it's also just not worded well. Which of the following statements is false regarding credit risk analysis? Um, so is a simple alternative to credit risk analysis to rely on credit reports issued by third parties. Um, that is true, right? You could look at credit reports instead of doing a credit risk analysis. It's not exactly the same, but it is an alternative, a very simple one, not one I would use, but it is an alternative. Um, Credit risk is not affected by aggressive application of accounting standards since cash flows are not impacted by financial reporting choices. Dude, that's totally false. Credit risk is affected by aggressive application of accounting standards. If you're pushing the boundaries on accounting standards to make things look different, that does mean you're a credit risk. So we know this one is false, but let's make sure that the others are true. Certain financial statement ratios are useful in predicting loan default. Yep, we've established that already in these discussions. A comprehensive credit risk analysis involves evaluating and summarizing various individual risks associated with a loan. That is also true. So this is our only false statement. And that is, in fact, the case. Valuing an entire company, an operating division of a company, or ownership shares involves three basic steps. These steps include, so this is definitional as well. Um, well, you just have to know what these steps are. And the only one that it's not is dividends, determining the dividends are going to be paid. There's not much I can add to this. These are the steps right here. So it is not this. Sorry, there's not much more for me to say. You just need to look in the book or listen to my lecture. Okay, so why do stock returns of firms reporting good news drift upwards before the earnings announcement date? So this is a short answer. You kind of can state it how you want to. Um, Basically, this is kind of like why we saw the drifting downward previously. If there's good news that's going to come up at an earnings announcement, typically a good analyst or a good analyst is out there analyzing the business beforehand and is going to know beforehand that the business is going to have higher earnings. So they'll know about the surprise before the surprise is actually announced. Fair value. So, um, so this is definitional as well. Um, fair value for accounting purposes, it is the exit price. That's just definition. It's not the market price in a forced sale, and it's not the entry price. It is the exit price by generally accepted accounting principles. There's nothing for me to add here to this. This is just the definition, and that is true. What is an earnings surprise? This is also definition. It's the extent to which those earnings are not what we expected, to which the extent to the earnings deviate from investor expectations. It says nothing about how security markets are inefficient or efficient. Security markets use analysts to make the best estimates they can. So there's nothing inefficient about them. In fact, security markets are quite efficient. Um, Bias exists since unbiased means it's not bias, it's just lack of information about surprises sometimes. An earnings surprise precedes a negative downward drift. It can, but it doesn't usually have to. This is just definition. A qualitative assessment of the business, its customers and suppliers, and management's character and capabilities. So this is definitional, and it's what we would call doing your due diligence. If you look up these other terms, they are not this. Due diligence is that qualitative assessment of asking questions about whether what is being stated is in fact true. And it is. So what is the exit price, right? We just looked at that in the previous question. Um, well, it wouldn't be, it would be, as the term exit implies, it'd be what would happen if we sold it. Now, how does that selling occur? It's not if you do a corporate buyout. It's not what you, because usually if you're bought out, usually the sale price is inflated to some extent because the other firm is kind of merging with you. Um, and it is when it's being sold. So that's why it can't be this option nor this option. It's actually being sold, which is this. So it's kind of definition of what an exit price is. Okay, so now if we use the discounted flows um, to equity valuation model, so what we see here is that the for that valuation model, the way that it works is that it's done after the payments are made to debt holders and shareholders. So it can't be this option, nor can it be. Sorry, I'm just reading the question a little bit closer here. It can't be this option because if it's before those payments to debt holders and preferred shareholders, it can't be about your future expectations about it. It can't be about future expectations. Discounted cash flows um, are not about future expectations. So this it can't be this option nor this option. So now we're stuck with these two options. It is about current expectations, but it's not. It's not before those payments. Um, it's after the payments are made. And it's just definition. It's about current expectations, not future. And it's after you subtract out the payments to debt holders and preferred shareholders. Because then you're looking at that cash flow after those required payments are made and then discounting those. And again, if my explanation of something you're not getting enough from me in how I'm talking about it, then really my only suggestion would be is look at the definition in the book a little bit closer. And if it still seems unclear, then let me know and I can kind of talk to you through it a little bit more. So, which of the statements is false regarding the business valuation process? So this is definitional as well. This chapter is really heavy on the definitions, just by its very nature. Um, so what we know here from in the business valuation process is that we are typically forecasting something. That is the nature of a valuation process. So already your eyes should be kind of drawn to this option, which I think is correct here without even reading the others. I'm thinking this is correct. Firms that earn less than the cost of equity capital produce negative abnormal earnings and generally have a lower. That has nothing to do with um, um, that. Um, Sorry, I didn't read the rest of this. Using factors from future value tables. Future value tables. Um, I'm not sure what that means. I think that's a throwaway. I think that's what makes this. This might actually be the false part of this. It is about forecasting future cash flows. That would be one way you would value a business, but I don't think that future value tables, that part doesn't make any sense. This is true. the share price will be below the book value when the cost of equity capital um, is not as much as what firms are bringing in or is what their revenue is. So that is true by definition. A component earnings that is unrelated to future cash flows or future earnings is not pertinent to assessing is considered a noise. Yes, that is true. That would be noise that we would take out, what a good analyst would take out. Income or loss from discontinued operations is considered a transitory component. That is also true. So I think this one is false, but the reason why it's false is that this first part is true, but this is really tricky. This first part is true, but I think the future value tables part is the false part here because that's not really relevant. We don't really have future value tables in the way that I think they're talking about it. This one's a little unclear of a question. I don't think you would. I shouldn't say you. I don't think you wouldn't see this on the exam. I'm not. If I don't feel confident about it and asking you as a homework where the stakes are very low, I certainly wouldn't ask it on an exam where the stakes are much higher. Expected abnormal earnings of a firm that has earnings of $40,000 with required equity cost of capital 8% and beginning book value of $800,000. Well, this one we can fortunately calculate it out. Fortunately, we're back to where I like to spend my time is in calculation world. Okay, so let's take our 40,000, which is our earnings, and we're going to need to subtract out the required equity cost of capital to 0.08% times the equity of 800,000. So 40,000 minus 64,000. That gets me a negative 24,000. So let's hope that this is correct, where the parentheses stand for negative. That is true. Okay, the fact that a firm's stock price does not change when earning announced, what is that basically telling us? So if the share price doesn't really change with the earnings announcement, typically what that would suggest for us is sorry, I'm just finding my page here. Typically, well, without even like looking at what I've got written out here, if the share price isn't changing, everything's already what we would call in the investing world. Everything's already baked in. We already know everything that's going on. So we would just say that everything was fully anticipated. If the earnings do deviate from expectations, that's where we'd see it drifting downwards or upwards. If the per share earnings were the same as the previous quarter, God, no, I would hope not. You want to see growth. If it's not that stagnant, that might be bad news. Security markets are rational and efficient. Although that is true, that doesn't mean that the share price does not change. In fact, because they are rational and efficient, it can just as likely go up or down just depending on what the earnings are. So it just basically means no surprises. Everything was fully anticipated. Okay, so then I ask you to basically define for me abnormal earnings and how does that affect how we look at things in terms of the valuation process. So the abnormal earnings, what that would mean is that there's a difference between the earnings that are announced, what's actually announced, and what the shareholders basically need as a return on their invested capital. So investors are basically right. The reason why stocks get the valuation that they do is that um, investors are paying for future earnings. If those actual earnings are different than what investors expected for in the future, that would be where things are abnormal. Um, and generally speaking, if there are some abnormal earnings, meaning that your business is doing better than investors would need to invest in you for the future, then the share price will go up. So you see this in tech companies a lot, where tech companies can have this like enormous growth in their earnings that makes it worth the risk that's being taken on. Okay, which of the statements are false regarding the business valuation process? One popular approach is to estimate a firm's equity is the CAPM. Um, that's true. CAPM is a popular approach, so that is true. A simplified version of discounted free cash flow model assumes zero growth perpetuity for future cash flows. No, God, I would hope not. Um, no, that's not true. You wouldn't just assume zero growth perpetuity. FASB, so this is false, but let's make sure the others are true. If a company is generating a sustainable free cash flow of $10 per share and the discounted rate is 10%, the estimated share price is $100. Yeah, that's by definition $10 times 0.1100. FASB contends that current accrual earnings are a proxy for free cash flow. Yeah, that's also true. So this is by elimination the correct answer. Income or loss from discontinued operations. We kind of already talked about these. That's the transitory earnings. And then finally, I ask you to define for me free cash flows and how we're going to use that in the business valuation process. So the free cash flow, by definition, that would be our operating cash minus what it takes to basically um, produce stuff. So the how much does it? How much do we have to spend on like buildings and equipment? Um, how much money do we basically have available to do everything else we need to do, like pay dividends, um, you know, um, basically pay debt, expand the business. We the free in free cash flow is that we're free to do with it as we please. So in terms then of how that affects the business valuation process, well, that cash basically has a value to investors. But if it's coming in the future, we need to discount it properly. So that discounted free cash flow, that would be one way of valuing the business. Okay, that does it for this chapter, which was largely definitional.